what would historically be done, and in fact, what ETFs like VXX are doing, is they're buying options on VIX futures, and you buy that here, and you continue to roll forward over and over again, and you're always paying a higher price for the further months out. That's because the market is a forward-looking thing, and the market has had this positive slope or contangoed structure in VIX for a long time, for a bunch of years. So it is true in a market crash, you often see this invert. The front month might go higher, the long month will go down. That's because the market is predicting that the volatility will end soon. That's generally a pretty good signal that a market bottom may be getting close at hand. Hello, everybody. Mike Preston here, New Harbor Financial Group. It is Thursday, May 30th, 2024. And each week we come here and try to share some data and some insight. Hopefully you can help you make some sense out of this craziness that we're living with. That's our purpose, and we really appreciate you tuning in. Please do subscribe to our channel and share your comments. We read them. And reach out to us directly if you want to have a conversation. Click down in the bio. There's the information on how to reach out to us directly. We're always happy to connect with you, always happy to share ideas. We look forward to speaking with you. So thanks for tuning in. And this week, I'd like to talk about volatility. We get questions a lot of times about volatility. How do you measure volatility? What is volatility? How can I play volatility? Is there a way to make money with volatility? That type of thing. It's a tough one. So first, let's talk about volatility. Volatility is the statistical likelihood that a price of something will change. It's measured in a lot of different ways. Sometimes people use standard deviation, that type of thing. In the market, there was this instrument called the VIX, VIX. And originally, it was based off of options attached to the S&P 100 index. A number of years ago, it was changed. So now it's based on the S&P Index, the S&P 500 Index, the SPX. And actually, it's the options on the SPX that are used to calculate it. So it's a pretty complex equation. It's probably not worth even sharing here, except here's what you need to know. It is a mixture of selected non-zero priced options on the SPX, both puts and calls. Calls are usually a bullish bet on a price, and puts are usually a bearish bet on a price. It is a weighted equation that is using the prices of calls and puts on the S&P option for a given time period. If it's the front month, it is the next month. If it's 2 months out, 3 months, 5 months out, etc. These things are calculated over different months, and then there's futures attached to them. So one thing you should know about volatility is it's very difficult to take a position in volatility directly. Okay, so here is the VIX on a daily chart basis, okay? So here's VIX. And we had a little bit of a pop to 14, almost 15 this morning. It's backed off to around 13.88. This chart goes back to last May or so. It's about a 1-year chart. You can see the volatility has been relatively tame. 12, 13, 14, there's been a couple pops higher. Late October, when the market had a pullback, we got up to 23. If we start to go out further, and I'll go back out to the monthly chart, so you just see how extreme it can get. This is a 20-year chart. In the 2008 meltdown, the VIX hit 89.53. Back in COVID, the VIX hit 85 again. And so the volatility historically has spiked and then trended down. Also historically, big spikes in the VIX have tended to coincide with good buying opportunities. Now, that's not always the case, and you don't know exactly how high it can go. Here's a weekly chart. But again, going back to the daily chart, you can see the VIX got really low recently. As much as early as last week, the VIX hit 11.52. That was a yearly low. So there's been very little worry in this market as measured by the VIX. Now, a lot of people say, I think we're going to get a market meltdown like we saw in 2008 or 2009. I want to go long volatility. I want to buy volatility. Here's the thing. I just explained to you that the VIX is calculated using calls and puts on the S&P index. You can't buy the VIX directly. You can buy futures on the VIX, and that may be not a bad way to go, but a lot of people don't have futures accounts. You are pretty much limited to using exchange-traded funds, something like this, VXX. This is iPath VXX, not a recommendation for or against. I'm just using this as an example of one product. The VXX attempts to mimic the VIX by buying essentially the 1 and 2 month VIX options, and it's essentially always rolling from the 1 month out options into the 2 month out options, and it's doing on a mechanical basis. The problem is that you can see from this chart that it's a fairly negative return. That's the weekly chart. Here's the monthly chart. This VXX has gone way down over time. And that's at a point where the VIX really hasn't gone down as much as this. And why is that? Well, to understand why that is, take a look at this. This is at VIXCentral.com. This is what's called the term structure of VIX. This is a very, very important thing. And it's very strange. It hasn't always been this way, but in recent years, it's been what's called a very contangoed VIX term structure. So the near month, the VIX is around 14. Okay, that's as of yesterday, basically. So 14, but out 1 month, it's 14.85, then 15, September, October. Look at October, it's out at 18 or so. Now, that's probably because we have an election coming up. So this is a positive slope in the VIX term structure. And this means if you want to have a position in VIX, what would historically be done, and in fact, what ETFs like VXX are doing, is they're buying options on VIX futures, or they're buying futures themselves, but normally options on VIX futures. And you buy that here and you continue to roll forward over and over again. And you're always paying a higher price for the further months out. That's because the market is a forward-looking thing. And the market has had this positive slope or contangoed structure in VIX for a long time, for a bunch of years. So it is true in a market crash, you'll often see this invert. The front month might go higher, the long month will go down. That's because the market is predicting that the volatility will end soon. That's generally a pretty good signal that a market bottom may be getting close at hand. And the further that this is out, very positively sloped like this, is usually a warning sign. But like so many things in this market, it hasn't mattered. And it hasn't mattered until it matters. So for most people, I wouldn't buy ETFs like VXX unless it's a short-term trade and you're monitoring it very closely. You could buy options on VIX, but even then you're going to deal with this what's called negative roll yield. Probably the best way to do this, if you really want to do it, would be some kind of option spread. Now, you have to be really experienced to do this, but you buy one call option on VIX, let's say, out in August. You might buy the August 15 call, and then you might sell the August 20 call. And then you can make the difference between 15 and 20 if you're right. But you're actually defraying the time value that you put out, and you're hoping to minimize this negative roll yield. And then I might say, lastly, for the most part, I wouldn't really bother with the VIX or trying to play volatility unless you're a professional. In my opinion, you're probably better off putting some type of short position in the market. You can even buy long-dated puts on the S&P 500. Those will certainly go up if volatility goes up. But VIX is a very difficult thing. Volatility is a very difficult thing. There's no easy way to participate there, really, without facing the negative things that I just talked about, the mostly being negative roll yield. And just because you take a position in volatility doesn't mean you're going to get a positive move in the month that you selected. So you might buy for instance, you might buy a VIX option out in October, and we could have a short-term market drop that would make the front month VIX spike, but maybe out in October, it doesn't budge. So I've seen a lot of people be frustrated trying to take a position in the volatility. I think the ultimate takeaway of this message is don't bother. But if you want to talk about it, give us a call. Click the link in the bio, reach out to us. Happy to have a conversation with you. Don't forget to subscribe, like the video, comment, and we love that you're watching us, and we really appreciate it. Until next week, this is Mike Preston at New Harbor Financial. Thank you very much.